The week starts with a relief rally in equities in Asia following an eventless weekend on the geopolitical scene, but the rest of the underlying risks continue to threaten the global risk appetite and also appetite for the US technology stocks. So, welcome to a week packed with big technology earnings with Swissquote's daily market talk. So the week starts with a relief rally after risk sentiment last week was hit by several and a wide-ranging set of factors. First, the week started last week, remember, with the news that Iran had hit Israel and ended with the news that Israel responded to Iran's attacks. For both attacks, though, the damages were limited and the countries looked like they were mostly trying to send each other hot messages rather than willing a full blast war. So as a result, we saw a rising uncertainty and volatility in oil prices, which happily abated last Friday after Iran said that they won't respond to Israel's response on Friday. So, that's one less worry to have for the global geopolitical scene and, of course, the inflation worries as well. So US crude kicks off this week under a decent selling pressure near the $81.5 per barrel level, but I still believe that the $80 per barrel psychological mark, which also coincides with the major 38.2% Fibonacci retracement on December to April rebound, will continue to act as a strong support to the actual retreat in oil prices as the Middle East tensions could resurface anytime. So the risks are still there. But one thing that could actually send the price of a barrel of US crude below the $80 per barrel level is a further fall in rate cut expectations from the Federal Reserve and eventually from the other central banks as well. Now, even though the European Central Bank's Villeroy said that they shouldn't wait much, even though the Middle East tensions drive oil prices higher, well, I think that there is little chance that the European Central Bank will ignore a potential U-turn in the euro area inflation if we see these energy prices surge and the US dollar appreciate on the back of the hawkish Federal Reserve expectations. So that's the second reason why the risk appetite was hammered last week, remember. The strong economic data from the US and hawkish comments from several Federal Reserve members will close the door on the expectation of a summer rate cut from the Federal Reserve. So the US 2-year yield, which has been testing the 5% psychological level to the upside since the 10th of April, looks ready to go above this level this Monday morning. And on the economic calendar, the US will reveal the first estimate of the first quarter GDP on Thursday this week, and the Fed's favorite gauge of inflation, the so-called core PCE price index, is due on Friday. The US economy is expected to have grown 2.5% in the first quarter, and the core PCE index is seen flat on a monthly basis and lower on a yearly basis. But note that Atlanta Fed's GDP now forecast points at a first quarter growth of nearly 3% in the US, and the last 3 CPI prints in the US surprise to the upside. So I think that the risks to the economic data from the US remain tilted to the upside for this week. Now, is it a bad thing? That's the basic question. And the answer is, it depends for whom. Because robust growth is good news for everyone if inflation continues to slow. Because otherwise, it is bad news because it would simply mean that the Federal Reserve should try harder to fight inflation by keeping its monetary policy at a sufficiently restrictive level to obviously slow down the economy and eventually push the economy into recession to fight inflation. Therefore, the combination of growth and inflation data will give investors the next indication regarding how far the Federal Reserve stands from its first rate hike. Now, looking at the activity on Fed funds futures, we see that, there is a more than 50% chance for a September rate cut only because all the summer rate cuts are now given less than 50% chance. And because September is just too close to November presidential election, that could actually delay the first rate cut from the Fed to the end of the year. So, voilà. What does that mean for the equity markets? Well, the equity markets, especially technology stocks, have significantly decoupled from the yields last year and the Federal Reserve expectations, and that was basically due to this rally that has been fueled by AI and optimism in the technology stocks and sent the S&P 500 and Nasdaq to record levels. But the first set of earnings from the most popular chip stocks disappointed last week, remember, because both the Dutch ASML and the Taiwanese TSM reported their first quarter results last week, and both companies failed to satisfy investors' expectations. Now, they both said that the AI should continue to boost their revenue and their profits this year, but the chip rally got hammered on the back of less than ideal results from these companies, and the Sensvanex semiconductor ETF took a 10% dive in just 3 trading sessions. So, if the earnings, which are pretty much the only hope to maintain the equity rally in place, can't do the trick, the US equities could actually see further losses. And indeed, the S&P 500 index posted its worst weekly loss last week in more than a year. The index fell more than 3% over the course of last week and closed last week below the 5,000 psychological level. Nasdaq 100, on the other hand, fell 6.5% over the week, and Netflix fell nearly 9% on Friday's trading session, despite revealing a third quarter of blowout subscriptions, the lower than expected second quarter forecast, and the company's decision to stop revealing the number of monthly subscriptions and also the revenue per subscriber were also perceived as a hint of a potential further slowdown in these subscriptions. Now, this week, four of the Magnificent Seven companies will be revealing their first quarter results, and they are Microsoft, Google, Meta, and Tesla. Now, we know that Tesla's results won't be shiny. We will be looking to see if Microsoft remains ahead of the AI rally this quarter, and we will also try to understand if Meta and Google are actually ready to take over after having heavily invested in AI tools over the past year. Now, looking at the news, the weekend was crowded with the news that Microsoft has now released a new tool called Vasa that actually could turn a picture into a talking and a singing video, while Tesla slashed prices of its vehicles in Europe, in the US, and in China to do what? Well, to boost sales and to reduce its swelling inventory. So it's also lowered the cost of its full self-driving software by a third in the US, remember, last week, to increase revenue in the short run. Yet the CEO, or the techno king Elon Musk's decision to replace a cheaper model of Tesla with robo-taxis actually pushed the company into a further chaos last week. So the Tesla stock price fell below the $150 per share level for the very first time since January 2023, and has further room to fall, in my opinion, with the announcement of the first quarter results, where the company is expected to report a 40% plunge in its operating profit and also its first revenue decline in 4 years. So the expectations are not great. Maybe that could save Tesla this week. We will see. But if the technology stocks can't boost appetite, the rest of the S&P 500 will hardly do so, because the S&P 500 index is expected to print a 4% earnings decline in the first quarter. So that's a decent contrast with the plus 38% earnings growth expected for the Magnificent Seven stocks. And among the Magnificent Seven, well, Tesla doesn't look all that magnificent anymore, and Apple has troubles as well. So all hopes rely on 5 stocks. 5 stocks will determine where the S&P 500 should be headed next. So this is all for this Monday. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive messages. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and please do not forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.